I know, should I buy it at 29? Should I buy it at 27.75 or whatever? Who knows? And when all is said and done, it's not going to matter. The whole idea is that you're getting your capital out of the system and into something that cannot bankrupt. Because when this whole thing goes down, mark my words, the great taking is very real, and a lot of people, a huge amount of people, are going to be left with nothing.
Gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. Summarize the fact that the retail market has been sellers this year, while the professionals have been buying, is actually the clearest indication that you've got that this is in the very, very early stages of a big bull move.
From precious metals, we see the central bankers doubling down on their efforts, doubling down over the last 2 months of the year, twice what the 12-month moving average is.
In today's episode, we bring you insights from 3 renowned financial experts, Bill Holter, Andy Schectman, and Alasdair Macleod. They dive deep into the latest developments in the world of gold and silver, sharing their perspectives on the forces shaping the market today. We've gone through hours of footage to curate the most compelling clips of the week, so you can stay informed and ahead of the curve. Before we dive into the best clips, like, subscribe, and turn on notifications, and check our pinned comment for some very special VPN offers. Let's get started.
I know, should I buy it at 29? Should I buy it at 27.75 or whatever? Who knows? And when all is said and done, it's not going to matter. The whole idea is that you're getting your capital out of the system and into something that cannot bankrupt. Because when this whole thing goes down, mark my words, the great taking is very real, and a lot of people, a huge amount of people, are going to be left with nothing. I've seen it all going back to, I was a broker during the 87 crash. So, I watched the reflations, I watched the credit bubbles, I watched the credit bubbles blow up, and we are in a global credit bubble not ever seen in the history of man. And I would just tell you that all credit bubbles blow up throughout history. I mean, you can go back hundreds of years, and every credit bubble ever has blown up. And that's where we're headed. I do want to mention, as long as we're talking about the stock market, you mentioned Warren Buffett. Warren Buffett, I mean, I can remember back in 1998, 99, people were saying, Warren Buffett's washed up because he wasn't buying the dot-coms. He was raising cash. He had a huge amount of cash going into 2000, 2001. And of course, the market cracked. Same thing happened again in 2007, 2008. He was raising cash, and he now, I think the number's 145 billion in cash is what he's sitting on. And that is the largest amount of cash outright, and the largest amount as a percentage that Berkshire has ever held. So the reasoning behind him raising cash, and I mean, he says this himself, is that he can't find anything of value or of good value to purchase. So cash is a better place to sit. Now, I do believe that when this does go down, Warren Buffett is going to find out that he's sitting on the wrong type of cash, because ultimately gold and silver, they are real monies. And historically, you went to cash for safety. And if you've got a credit event happening, how safe are some of these sovereign debt securities going to be? I think we're going to find out that, not everything's AAA rated, not everything's safe. And we're going to find a bunch of sovereigns that get discounted and downgraded, maybe even completely collapse.
In today's news recap, gold prices see some profit taking, but hold the line above 2,700 as housing starts rises 15.8% in December. Gold is facing some selling pressure, but remains above $2,700 an ounce, even as the U.S. housing market shows signs of stabilizing with improved housing construction activity in December. Housing starts jumped nearly 15% last month to a seasonally adjusted annual rate of 1.499 million units, up from November's reading of 1.294 million units, the Commerce Department announced on Friday. The data significantly exceeded expectations as economists had forecast a slight increase to 1.33 million units. Despite the monthly increase, the report noted that housing activity is still down 4.4% compared to December 2023. Better than expected construction data is adding pressure to gold, which is already experiencing some profit taking after prices hit a 2-month high on Thursday. Spot gold last traded at $2,705.90 an ounce, down 0.32% on the day. Technical analysts will monitor whether the $2,700 level holds as support. This level has acted as solid resistance, with prices consolidating in a narrow range over the past 3 months. Economists are closely monitoring the U.S. housing sector due to its significant impact on GDP. The sector has struggled as consumers have been priced out of the market. Higher interest rates have pushed mortgage rates higher, while low inventories have kept prices elevated. Some economists expect the housing market to continue facing challenges as the Federal Reserve looks to shorten its easing cycle through 2025. Markets are currently pricing in one 25 basis point cut this year. Now, we'll show you the best clips from the latest interview. But first, like, subscribe, and turn on notifications so you don't miss our daily recaps. Also, check out our NordVPN deal. It's the fastest and most reliable VPN on the market. If you're a stacker, this is a perfect fit for you because safeguarding your internet data from government surveillance will be crucial moving forward. For a small cash outlay, you can ensure you're protected from prying eyes. Check the link in the pinned comment and get 3 free months today. Enjoy the episode.
China and Saudi Arabia doing all they can to covertly, privately, although they've been caught twice now, accumulating gold and listing far less than they're actually buying. In other words, the biggest money in the world, the central bankers who know the playbook, the biggest money in the world who's draining the exchanges off of COMEX and the LBMA, the biggest money in the world that is creating shortages in industrial grade bars, are ahead of the curve, where the retail consumer is again being misdirected largely into areas that you could argue on many levels are overvalued. In that December, there just on COMEX alone, there was 25,642 gold contracts delivered, the second highest delivery volume in almost 3 years. And in silver, it was ridiculously high as well. And so what we're seeing is the insiders, the big money, the central banks, the sovereign wealth funds, they're standing for delivery, as the retail investor has been, I think, mesmerized by the shiny objects over there, the Bitcoin and the Nvidia and the Apple and all of these stocks and cryptocurrencies that are posting returns. And I remember Richard Russell saying, if you make 7% a year, you're a rock star. And now gold making 30%, as you mentioned, in a year doesn't excite anybody. And that's very dangerous. But I guess at the same time, what I'm really getting at is, you're right. The selling has been stronger than at any time since 2017, but so too has very large purchases by people who understand what's happening. So the person looking to make a profit, which I think is not the reason to buy gold and silver, they're looking elsewhere. The people who are looking to preserve and understand economics understand that the math, as Bill always says, is moving into an area that is not sustainable. Well, they're contributing larger amounts of money into gold and silver, maybe even first-time clients. But the trend that I see is of the public looking elsewhere as the insiders are draining the exchanges. And that's classic misdirection, and that should portray for higher prices down the road, if I had to guess. I know a lot of the rhetoric surrounding the BRICS nations has somewhat died down. I expect to see a reemergence of this discussion in 2025. Trump saying he'll enact 100% tariffs on the BRICS nations for continuing their desire to move away from the dollar. That's not a tariff. Tariff protects manufacturing, domestic manufacturing. That is a sanction masquerading as a tariff. That is financial warfare. That is not something that I think will dissuade the BRICS from continuing to move forward. I think that from a domestic standpoint, I think the debt issue is something that has to be front and center. I mean, even Trump just sent out a tweet the other night saying, thanks to what the Democrats have done, 2025 could be a 1929 style depression. You look at the latest Treasury data that was just released for November, which was the second month of fiscal 2025. The U.S. spent $584 billion for October and November. That's the first 2 months of 2025 for the fiscal calendar year that Trump is inheriting are officially the worst start to a year ever for the Treasury. When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market, or with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many treasury securities will have to be created to do so. At the same time, many of the countries that traditionally supported our debt are moving in the other direction. So I think that's something that we'll have to continue to watch very, very closely.
In today's news recap, Goldman Sachs now sees $3,000 gold only next year as fewer Fed rate cuts slow 2025 price growth. Gold's record-breaking rally will slow down this year, with the yellow metal taking longer to reach the $3,000 level. But steady central bank demand remains a key long-term price driver, according to a leading investment bank. Goldman Sachs Group Inc. announced on Sunday that it no longer expects the gold price to reach $3,000 per ounce by the end of 2025, with the Federal Reserve's shallower rate cut path pushing the forecast to mid-2026. Goldman analysts, including Lena Thomas and Don Stuyven, wrote in the update that slower monetary easing will likely depress demand for gold-backed exchange-traded funds, ETF, in 2025. They now project the spot price to top out at $2,910 per ounce by the 2025's fourth quarter. The analysts added that weaker than expected ETF flows in December, driven by easing uncertainty after the U.S. election, also resulted in a lower starting point for gold prices into the new year. Opposing forces, lower speculative demand, and structurally higher central bank buying have effectively offset each other, keeping gold prices range-bound over the past few months, the analysts wrote, but added that demand from central banks will remain a key driver for prices over the longer term. Looking ahead, we forecast monthly purchases to average 38 tons through mid-2026. Goldman's economists now expect 75 basis points of interest rate cuts this year, down from their previous prediction of 100 basis points. The updated forecast is still more dovish than current market pricing as the bank sees underlying inflation trending lower. The analysts also said they were doubtful that the incoming Trump administration's policies will necessarily lead to higher interest rates. Now, we'll show you more clips, but first, subscribe and turn on notifications so you do not miss out our daily recaps, and check our NordVPN offer if you're a serious stacker, because keeping your browsing data safe from the government will be crucial moving forward. Also, check goldsilvermerch.com to get your gold and silver gear today. Premium quality shipping worldwide by Stackers for Stackers. Enjoy the episode.
The only people who participate early in the next bull market are basically the people who really know what they're doing. The real pros. The guys, for example, sort of in, let's say the mining industry, something like that, who understand mines, they're in there buying stuff and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community. But again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott Wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up, and they buy it just because it's going up. Now we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts, since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year while the professionals have been buying is actually the clearest indication that you've got that this is in the very, very early stages of a big, big bull move. Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.